Hello guys, today we are going to talk about accounting for receivables, and this is going to be your unit number 2, right? It's the first lecture on unit number 2. In unit number 2, we have in total 2 main topics. We have to learn here accounting for receivables. And second topic is what we have to learn about accounting for inventory. So these are the 2 topics. Okay. So we are going to cover this section in this lecture, accounting for receivables. At the end, I will guide you like how to use the software, and you have to do the question for which topic. So here we go. So we have here first thing, which is called trade receivables. Trade receivables mean to say, which is also called your accounts receivables, okay, are amounts owed to an entity by its customer resulting from credit sales in ordinary course of business. So that are due in customary trade terms. So what it means, mostly like as a business, when we sell goods on credit, so obviously against those credit sales, the customers, they will pay us in future, right? It means we have a right to receive the money against that credit sale. So obviously those customers who will pay us in future, that is called receivables in the seller book. Okay. In the buyer's book, obviously it is the payable. So we are talking about a trade receivables. So what is your ordinary course of business? Ordinary course of business means to say, if you are selling goods or providing services, due to the sale of those goods or services, credit sale of those goods or services, you will receive the money in future. So that is your normal business. Okay. So here we go. What is the customary trade terms? It means obviously some businesses, they might have credit terms for 30 days, like customer will pay after 30 days. Some businesses, they might have credit terms for maybe 90 days, maybe for 60 days. So these are called customary trade terms. Okay. So here we go. Note. What is the note? All other receivables. Obviously, those receivables which are arising other than credit sale. Maybe you have given loan to others, right? And it is not your normal business. All other receivables are called your non-trade receivables. Non-trade. Trade receivables will always arise due to credit sales. If you have a loan receivables, if you have interest receivables, maybe dividend receivables, or maybe lease receivables, so those are called what? Non-trade receivables. Okay. Now, guys, here we go. We have here note. What is the note? Receivables should be separated into current assets and non-current asset portion. So what is the definition of current assets? We already covered in our earlier lectures. So normally current receivables, these are those receivables which will be received within 1 year from the reporting date. Okay. So receivables are classified as current if they are expected to be collected within 1 year or the entity's normal operating cycle, whichever is longer. So obviously, because our topic is trade receivables, not the non-trade receivables. So here we go. We are moving to the main idea now. So trade receivables, always you will record in your balance sheet at net realizable value. It is also called NRV. Net realizable value. So what is net realizable value? This is how it will look like in your balance sheet. So net realizable value means that you have to take gross account receivables. So far you have to understand gross means a total amount of receivables. Okay. From there you have to deduct allowance for uncollectible accounts. So what is allowance for uncollectible accounts? I will explain obviously in detail, but here I'm giving just overview. For example, if you have a total receivables of $100 and your past experience shows that every year maybe 5% of receivable is uncollectible due to any reason. right? Maybe due to default or maybe due to any reason. So you are not collecting 5% of the total receivables. So for that, we have to create allowance. What is allowance? That we will see. Actually, with allowance, I will explain how matching concept works here. So allowance for uncollectible means, so this is the portion of amount which is not collectible. For example, if total receivable is 100, out of 100, we are assuming that $20 is not going to be collected by the seller. So it means the remaining portion, $80, which is collectible, that portion is called what? NRV, of account receivables, or net realizable value, which is realizable, which is convertible into cash, which is collectible. Okay, guys, so we are going to work with this format now. This is the presentation of balance sheet. Like this is how it will be presented in balance sheet. Now, here we go. I'm going to explain first two words because we have to understand these two words. So what is the gross account receivables and what is the allowances for uncollectible accounts? So I'm going to start with first allowance portion. What is this account? And then we will move with the entries to the everything. So here we go. Note 1, I'm explaining allowances for uncollectible accounts. It is also called bad debts expense, right? It is also called irrecoverable debt. It is also called credit loss, allowance for credit loss, like bad debts, uncollectible accounts, right? Irrecoverable debt or the credit loss. These are the terminologies which can be used interchangeably in your exam question answer. So allowance is what? So here we go and let's understand what is the allowance. Obviously, as I told you, collection in full of all account receivable is unlikely. Right? So that is why allowance for uncollectible account must be recognized. So what is the note here? Actually, how do we record allowance? So how do we record allowance, guys? So this allowance methods, attempts to match bad debts expense with what? With the related revenue. Actually, this is called what? Matching principle. So what is the matching principle? Please understand the period in which you will book the revenue, you will record the revenue. In the same period, all related expenses you also need to record. For example, if I have booked the revenue in 20x2, for example, in 2022, so the bad debts expense relevant to this revenue, I have to book in the same accounting period. This is called what? Matching principle. And you will better understand with the help of example. So here also remember the allowance account which we create, or allowance ledger, which we deduct from the gross receivable in the balance sheet, amount of allowance. So actually this ledger is called what? Contra account to the account receivable. Whenever we use the word contra account means say it is going to be deducted from the main account. That's what it's called contra. Okay. Then, so there are two approaches practically which we can use to estimate the allowance for credit loss or for irrecoverable debts or for bad debts. The first approach which we need to understand, that approach is called income statement approach. Because when you will perform the question in your exam or during the practice session, so first you have to identify which approach you have to apply in questions. Is it an income statement approach or it is a balance sheet approach? Second approach, we have which approach? Balance sheet. How would you know it is an income statement or balance sheet approach? So sometimes it might not be stated in the question directly, but you have to identify from question itself, it's an income statement or balance sheet approach. What is the identification criteria? So here we go. If in your exam questions, you are told that the X percentage of sale is uncollectible. Any X percentage of sale, 2%, 3%, 5%. So you know sale is the income statement item. So if percentage is applicable on sales, it means you have to deal according to the income statement approach. Right? Or if in your exam question, you are told that there is some X percentage of receivable is uncollectible. You know, receivable is a balance sheet item. Yeah. It means you have to work in accordance with the balance sheet approach now. Right? This is the identification method. So guys, whatever method you will apply, so you need to have information about two things. Number one, right? I'm telling you the first thing, regardless of income statement approach or the balance sheet approach. So these are the general things which will be followed in income statement approach also and in balance sheet approach also. So first of all, there is one equation which you have to complete before moving to the solution, right? The equation is what? You have to take opening balance of allowance for credit loss, opening balance, which might be given in the question. You have to add here allowance for the year, allowance for the year you have to add. So this is going to be equal to closing balance of allowance. First, always complete this equation. Okay. Now, here you have to understand the things. This value you will always take as an expense. As what? Expense to income statement approach. Regardless you are applying income statement approach or balance sheet. This value you will take as expense to the income statement itself. And this value, it's very fruitful summary because these are the common mistakes which you will make. This closing balance of allowance, you will always deduct from receivables in balance sheet. You know, in balance sheet, you need to write gross receivables less allowance for uncollectible accounts. This is the value which will be deducted there as allowance. Okay? Understood? This is the first thing. I hope that is clear. Now, guys,
Mr. Sorry, where will we deduct it from?
I will tell you, don't you worry. It's just so for whatever explaining, just try to keep in your mind.
Okay.
That we have already discussed NRV calculation. So there, that I will show you with the example also. So far, what we have here, expense. This value will record the expense to the income statement, and this value will deduct from receivable in the balance sheet. So let me tell you the entry for expense which will be taken to the income statement. Double entry would be what? You have to debit bad debts expense, which is also called credit loss expense, also called irrecoverable debt expense, or also called uncollectible expense. You will debit this account and you will credit what? Allowance for receivables or bad debts or for uncollectible accounts, you will credit to them. Okay. Now, this entry you also need to remember, huh? Credit side is, okay, now here we go. How you will deduct from the balance sheet? Obviously, I'm answering your question as well now. Under current assets in the balance sheet. Under current assets, you have to record receivables at NRV. And how you will get NRV of receivables? You need gross receivables, I would say total receivables. Okay. From there, you have to deduct allowance for receivables. And allowance for receivables means which allowance? Closing allowance. This is a closing allowance, huh? Closing, this value. You will deduct from there. So this is equal to your what? It's equal to net realizable value of receivables. Understood? Regardless whatever approach you will follow. Because approach I didn't start. I will start now. So these are the two things I told you. Number one, complete the equation, which is equal to opening allowance plus allowance for the period is equal to closing allowance. Allowance for the period will be taken as expense to the income statement, and closing allowance you will deduct from the balance sheet. Right? Now we are going to work with first income statement approach, because there are how many methods? Two methods. And even you will use income statement or balance sheet, you have to complete these two things. Clear? So here we go. I'm going to start with the income statement method first. Obviously, whenever any percentage which is applicable on credit sale, for example, 20% credit sale is not recoverable. So it means it is a income statement approach, because credit sale is the item of income statement. Okay. So how it is going to work? Let's have a look with the help of example. So we have an example here. Please just need your concentration, automatically you will understand easily. So for example, we have a company. Its year's end unadjusted trial balance. Unadjusted, it's not adjusted for bad debts. Reports the following amount. First of all, you have a gross receivable of how much? 100,000. Then you have a credit sales of how much? 250,000. And you got a opening balance of allowance of 100,000. Credit. Why allowance is credit? Obviously, if asset is debit, it's a contra account, so it should be a credit. Right or wrong? So here we go. According to the past experience, 1% of credit sale is uncollected. 1% of credit sale. Guys, please remember. So it means we have to get this value first, 1% of the credit sale. So we will take it here 1% multiplied by credit sales, net credit sales. Net credit sales means the sales minus sales return. Right? So once you will apply 1% of credit sale amount is how much? 250,000. Once you will apply 1% on that, need your concentration now. 1% of 250,000. This will give you amount allowance. And under income statement approach, this allowance will be treated as allowance for the period. What it will be treated? Allowance for the period. When you apply percentage on credit sale, it is equal to allowance for the period. Done? Great. Now we have to complete equation. What's the equation? We have to take opening balance of allowance, which is 1,000 given in the question. We will add there what? Allowance for the period, writing shortcut for the period. Right? It is how much? 2,500, which got it here. We got it here. Is equal to closing balance of allowance. Closing balance of allowance, which is 3,500. Understood? Now we have to complete the entry also. This value will be taken as expense to the income statement. And you have to record this entry if he will ask you the question. Debit credit loss expense by 2,500. And you have to credit what? Allowance for the allowance for receivables, 2,500. Actually, this amount you are transferring to allowance ledger. That is where we added there, right? Right or wrong? Now, guys, how you will present in your balance sheet now? If he will ask you what is the amount of expense which will be taken to income statement, you would say how much? 2,500, which is for the period, right? And how the receivables will be recognized are presented in your balance sheet. So you have to follow the formula. With this value, you have to deduct closing allowance from gross receivables. So in balance sheet now, this is the balance sheet presentation under current assets, under balance sheet. Current section, you will write it gross receivables, I guess, which is in my example is $100,000. From there, you have to deduct closing balance of allowance, which is how much? 3,500. So 96,500 will be your net realizable value. Understood? Now This is what is income statement approach, that's it. Right? And now I'm going to explain what balance sheet approach, how the balance sheet approach is going to work for allowance. So here we go, guys, balance sheet approach. Obviously, here you will be provided with the percentage which you have to apply on which balance, on ending balance of receivables. And receivable, for example, you are provided that 5% of receivable is uncollectible. It's a balance sheet approach because receivable is the item of balance sheet. Understood? Now how you will work? Let's have a look with the help of example and see the differences and the similarities between both methods. Okay. So we have same example, just changing the percentages. Right? So we have here companies year-end unadjusted trial balance reports the following amounts. We have gross receivable, we have credit loss, we have opening balance of allowance. And according to the past experience, 5% of account receivables are determined to be uncollectible. So this is 5% of receivables. Receivable amount is how much? 100,000. Understood? So here we go. First of all, you have to take 5% of receivables. Okay, so this will give you how much? 5,000. And please remember, under balance sheet approach, this will be allowance. But which allowance? Closing balance. Under income statement approach, it was allowance for the period. When you apply percentage on sale, because sale is for the period. This here when you apply percentage on receivable, this is called closing balance allowance, because this receivable you are taking from balance sheet, which is closing. Clear? And now how much is the allowance value? 5,000. Closing allowance. Again, you have to complete the equation. What's the equation? Opening allowance, which is given the question, $1,000 plus allowance for the year, which you need to know, and it will be equal to what? Closing allowance balance. Closing allowance balance. Closing allowance balance is how much? 5,000 you have already, which you calculated just now. Right or wrong? This 5,000. Understood? So now obviously the difference of these two, opening and closing, will be the allowance for the period. It is going to be how much now? 4,000. Right or wrong? So now here you got this as a balancing value, right? Allowance for the period. Always complete the equation first. Now what you have to do? You have to record this allowance for the period as expense in the income statement. You have to record as expense where in the income statement. And what will be the double entry? Debit credit loss expense by 4,000. Credit what? Allowance for receivables or uncollectible accounts by 4,000. Understood? Now how data will be presented in balance sheet? Because this value you have to deduct in the balance sheet. In balance sheet, you have to take what? Gross receivables under current asset section. Okay, gross receivables are how much? $100,000. We have to deduct from what? Closing balance of the allowance, which is how much? Closing allowance, which is how much? 5,000. This will be equal to your net realizable value receivable, 95,000. Understood? So this is how you will work with it. So guys, so these are two approaches. Presentation is also there. Okay, we have completed here equations. Okay, here we have a double entry. Okay, and here we have a presentation. For income statement, you will write brackets expense there, and for balance sheet, you will follow this as a template. Clear? I hope so. It is easy. Now, guys, we are continuing with the balance sheet approach, because here we got one amount of receivables and we applied percentage of that amount on that amount, right? Sometime in your question, you might be provided with more than one amount of receivables. What I mean, I'm trying to say with aging. Aging, you know how old they are in terms of payments, in terms of outstanding period, right? So sometimes data might be given in aging, like receivables, which falls within 0 to 30 days, or between 30 to 60 days, or between 60 to 90 days, or over 90 days. And for each category, you will be provided with the amount of receivables. And for each category, you might have a different percentage of allowance also. Right? So in that particular scenario, so how you are going to work? So this is we are going to do now. So here we have balance sheet approach with aging schedule. With aging schedule. Okay. So here we go. Let's assume rest of the question is the same. We have receivables, total receivables, I'm assuming total receivables, we have 100,000. We have credit sales to 50,000, same question I'm keeping, right? We have opening balance of allowance as 1,000 credit balance. And but now for receivables, breakup is given. What is given? Breakup. For example, here he told you aging intervals. Like how old they are. Okay, so we have receivables which will fall within this limit less than 30 days. Then we have a 30 to 60 days, 91 to 61 to 90 days, over 90 days, and these are the amounts of receivables. Total is how much? 100,000, because it's a breakup of 100,000 of receivables. And don't you worry, this aging schedule will be provided. And practically, you can maybe do this work on Excel sheet also, and you can create aging. You can get aging report from the accounting software as well, if it is there, right? Now, this information will also be provided in the question. Estimated uncollectible percentages for each category. So, for example, for first category, our uncollectible percentage is 2%. For second category, it is 5%. For third category, it is 13%. For fourth category, it is 20%. What do you have to do? Simply, you have to take each category balance and you have to multiply with estimated uncollectible percentages. And what you will get here ending allowance, because under receivables, whenever you apply percentages on receivable, so you are getting ending receivables. Clear? Now, here we have 70,000 times 2%. It will give you 1,400. 18,000 times 5%. It will give you 900. 1,000 times 13%. It will give you 1,300. 10,000. Okay, 2,000 times 20% will give you 400. So total allowance is going to be 4,000. And again, you have to complete the equation. We got opening allowance, which is $1,000. You will add here allowance for the period. And you will get closing allowance because you have closing allowance of 4,000. Obviously, the difference of these two will be allowance for the period. And this value you will take to the income statement as expense. So it will be expense entry. I told you already, same entry. Okay, debit, credit, loss, and credit allowance for uncollectible account by 3,000. And this value you will deduct from your balance sheet. Under current asset category, you have to write gross receivable. I'm assuming these receivables are $100,000. From there, you have to deduct closing balance of allowance. So which is 4,000. Now NRV of receivables are going to be 96,000. This is going to be your NRV. Now, topic is not completed. Obviously, now I'm going to add some information. Sometimes similar question will be given as a performed here. He will give you some data. He will ask you what value you will take to income statement, or he will ask you to calculate carrying value of receivables. Carrying value of receivables means this NRV. Carrying value, it's also called net book value, net realizable value, and what you can ask. Okay. Here we go. Now we have some more information regarding this topic, and you must be aware with these entries also by following debit and credit rules. And then I will prepare a statement form for you guys. Okay, so which we can use to solve the questions. To solve the question, statement form is enough, but just to clear the concept, we need to go through entries. So these are additional entries which might affect either your amount of what? Gross receivables. It might affect either the amount of what? Allowances. So this is what is called NRV. So these entries are relevant to these two topics. Some entries might affect gross receivables, some entries might affect allowances. Okay, ready? Need your concentration, it's important now. So here we go. First entry which is relevant to this topic, obviously the entry for credit sale. At the time of credit sale, what entry mostly we pass? Obviously we debit the receivables, we credit the sales. So see, this will affect the receivables. Second entry at the time of sales return, I'm assuming if you are not creating any allowances for sales return, simple sales return. So you have to debit sales return and credit what? Receivables. See, this entry is also going to affect receivables. It will be deducted from receivables. Whenever receivable is debit, it will be added. Whenever receivable is credit, it will be deducted from receivables. Right? When we create the allowance, when we talk about the allowance, whenever allowance is credit, it will be added. And whenever allowance is debit, it will be deducted, opposite, because it's a contract. Okay. So there is another entry at the time of collection from receivable. So what entry you will pass? You will obviously debit cash, credit receivables, and this entry will also reduce the amount of receivables because receivable is credit. Yeah. Understood? Otherwise, I will tell you at the end equations, but here I'm just explaining the concept as well. So then at the time of creation of allowance, when you create the allowance, allowance for the period when you got it, by completing the equation of opening allowance plus allowance for the period is equal to closing allowance. Allowance for the period, what entry we have already passed, we already learned. We will debit bad debts expense, credit loss expense, whatever name you want to use, and credit what? Allowance for uncollectible. Clear, guys? Here, I already told you, this will be recorded as expense in your income statement. And this allowance will be transferred to the allowance ledger, which will help you to get closing balance of allowance, and then you will deduct from the balance sheet. Right? Here we have some theoretical questions as well and entries as well. Entry number 5. At the time of write-off bad debts. Write-off is what? For example, generally, I was thinking 5% of receivable I will not collect, assume. But now I came to know Mr. A, he got declared bankrupt, or he is going to leave the country, or he has already left the country, or simply he has denied that he will not pay. And I'm sure now I'm not going to collect this money. So it means what I have to do, I have to write off, we'd say kick off from my financial statement. Right or wrong? So how you will write off and what entry you will pass to remove that receivable. So you will debit allowance for uncollectible account, because allowance you have already created. Yeah. In general, now you will reduce that amount of allowance and you will credit what? The receivable, because I need to kick off that customer from my balance sheet from receivables. right? And here points to be remembered. With the help of example, I'm going to explain the next three theoretical points. These three theoretical points. So here we go. I'm assuming values here, please. I'm assuming we have a gross receivable of $10. We have allowance for receivables. Allowance we have for receivable $3. Our NRV of receivable is how much? 7. This is the position before writing off. Before writing off that customer. Okay. Now what happened? For example, I have written off that customer now, and the amount is $1. $1. So what's the entry? Debit allowance and credit receivable. It means this $1 will be deducted from receivables also, and this $1 will be deducted from allowances also. It means receivables are going to be 9, allowances are going to be 2 because allowances you have reduced. Again, your NRV is how much? 7. So see, there is no change in NRV, but there is change in the presentation. Understood? So question number 1 regarding writing off the bad debts. Number 1, write off of a particular bad debts has no effect on expense. You can see there is no account is debit or credit with expense. Right or wrong? It means if it is not going to affect your expenses, obviously it is not going to affect your profit also then. Right? Because profit you will get to the deduction of expense from the revenue. If expenses are not affecting, so there is no effect on the profit as well. Understood? Radical question, he will ask you the effect of write-off on expense. You will say no effect. Then question number 2, write-off bad debts do not affect the carrying amount. Do not affect the carrying amount of net receivable. And you can see here, carrying amount is the same, 77. Right or wrong? Carrying value is not going to be changed. Then, note number 3, write off a particular bad debts do not affect the carrying amount of net receivable. This we have already covered. Note number 3, they also have no effect on what? Working capital. Actually, what is working capital, guys? Working capital means current assets minus current liabilities. Current assets, obviously, it will include the item of receivables, and you can see receivables are unchanged. Receivables are unchanged. It means we will assume working capital will also not change then. Right? Understood these 3 theoretical points? You have to keep in your mind. Memorize it strongly. Now, guys, we have entry number 6, which belongs to this topic as well. Entry number 6 is what? At the time of recovery of bad debts previously written off. For example, Mr. A, 6 months ago, he denied that he is not going to pay the money, simply, in harsh words. So we assumed that time, 6 months ago, that we are not going to collect the money. So we have written off. And when we have written off, what entry we have passed, guys? We debit the allowance at the time of writing off. And we credit the receivables like Mr. A account, right? But after 6 months, he thought, no, it's extremely unethical, unprofessional, right? So I had to pay that money to the seller, right? Or to the receiver. So now he decided to pay the money and he called you just and he transferred the money. So what happened now? It means you have recovered bad debts which were previously written off. This is called recovery of bad debts. Right? Now there are 2 different ways which you can use. One is long way, second is short way to account for this transaction. Okay? First long way is what? Step number 1, what you have to do? You have to reverse the previous write-off entry. What was the previous write-off entry? Debit, allowances, credit, receivables. Reverse it. So you will debit receivables, credit allowance. Now again, your receivables will stand in your financial statements, in your ledgers. So now, second entry, what? You will record the cash, normal cash collection. You will debit the cash, credit the receivables. Now, if you look these 2 entries, guys, here receivable is debit and here receivable is credit. So these two will be cancelled. So what is the net entry, remaining entry? On debit side, you have a cash and credit what? Allowances. So this direct entry you can also pass if you do not wish to pass these two entries. You can pass direct this entry also. Understood? And if you look at it, again, there is no effect on expense or on income. Right or wrong?
Yeah.
Now here we have a summary regarding allowances method. And this summary is much more important to solve your exam questions. Okay? By the way, those additional entries which we have just studied, those entries are written here in the statement form, like which things will be added to the receivables, which thing will be deducted from receivable, or which thing will be added to the allowances, which thing will be deducted from the allowances. Right? So first of all, we are here. I'm going to explain the summary of allowances for uncollectible account, not the gross receivables. Allowances for uncollectible. And this format you have to memorize in plus minus shape. Here we go. First of all, you have to take what? Opening balance for uncollectible account. Opening balance of uncollectible account, which will be given. Then you have to add what? Bad debts expense for the period. You know, allowance for the period. For allowance for the period, you have debit the credit loss expense, credit allowance. Actually, that is the value. Bad debts expense for the period. Okay. Then you have to deduct what? Account receivables written off. Obviously, when you write off the receivables, you have debited the allowance, credited the receivables. So that value will deduct it. Okay. Then you have to plus what? Collection of account receivables previously written off. You know, direct entry for recovery of bad debts was debit cash, credit allowance. So allowance needs to be credit, so we will add this value. So this is equal to what? Closing balance of allowance. Now guys, here I want to tell you one thing. Maybe in your exam question, let's assume he told you everything. He told you closing balance of allowance. He told you this value, this value, this value, but he's asking you to calculate this value. What is this? Bad debts expense for the period. How would you calculate? Go reverse. Reverse how? From bottom to top. When you go reverse, plus sign will become minus, minus will become plus. On your calculator, first value you will take what? Closing allowance. This value was added, now you will deduct. This value was deducted, you will add. This value is positive, you will deduct. So automatically on your calculator, you will get what? Bad debts expense for the period. Right? Maybe now I'm changing. Maybe he told you all other things. But he's asking you to calculate this value. What is this? Collection of account receivables previously written off. So you have to go reverse. Again, go reverse. Because if any these items are missing, first four, you have to go reverse. If fifth item is missing, you have to come straight. Right or wrong? Whenever you go reverse, plus will become minus, minus will become plus. Understood? This equation you have to strongly memorize. Now we have a summary for what? Gross receivable. That was for allowances. Okay. Now we are talking for gross receivables. So here we go, guys. Here you will take first of all opening balance of gross receivables statement form, opening balance. Plus what? Credit sales you will add. Less what? Sales return you will deduct. Less collection from customer, cash collection, you will deduct. Less account receivables, return off you will deduct. Because at that time of writing off, you have credited the receivables in the double entry. So this is equal to what? Closing balance of account receivables. Now guys, if you are required to calculate this value for your exam, closing balance, you have to come straight. But if any of these values is missing in your exam, you have to go reverse them. Reverse mean to say plus will become minus and minus will become plus. Understood?
Yeah.
The summary you have to memorize, huh? Please. Now, we have a 3 allowance approach is done. Right? Now, guys, let me tell you one more thing. It's important to understand. There are 2 ways, practical ways. Maybe the second, which I'm going to tell you, most of the people in small companies, they are following this process. So there are 2 ways to deal with the 2 ways to deal with bad debts. Right? The first approach is called allowances method. Huh? Allowances. Under allowances, we have studied 2 approaches: income statement approach and balance sheet. And this allowance method is recommended by IFRS and by GAAP also, right? Because it follows which principle? Matching principles. There is another method to deal with the bad debts expense, that is called direct write-off method. Okay, guys, direct write-off method. This is what I'm going to tell you now. Here you do not need to calculate any allowance. No, you have to just wait till the actual time of the bad debts. Who is denying? At that time you will do something. Otherwise, you will not do anything. So here we go. Let's move to that side now. So starting with these 3 notes. Note number 1. Allowances methods are allowed by GAAP or IFRS, as I told you, because it follows the matching concept. Second, direct write-off method is not allowed by GAAP or IFRS, but there is one exception. What is the exception? GAAP says, because our primary focus on GAAP, it says you can follow direct method if you feel the result of allowances method and direct write-off method is not materially different. If there is no significant difference, if you feel like it will produce almost similar results, either you will follow allowance method or you will follow direct write-off method. So then it's up to you, you can follow direct write-off. But if you feel allowance method gives you completely different picture and direct write-off method gives you completely different picture, then allowance method is recommended. Got it? This is for accounting. You know, for tax authorities now, tax authorities, you have tax authorities in your countries, they don't accept allowance method. See, the reason, it is based on our estimate. Right or wrong? Tax authorities, they always accept direct write-off because it is reality based. Because you will book expense and you will reduce receivables under direct write-off method at the time of actual event, not on based on estimate. So that's why point number 3 is what? Direct write-off method can be used for tax purpose only, but you can use for accounting purpose as well if allowances method and direct write-off method will produce same results. Understood? So now guys, here we go. What's the difference? We are going to talk about, and we are going to discuss the problems with direct write-off method as well. Ready? Point number 1, starting point. The direct write-off method expenses bad debts, like you record expense, when they are determined to be uncollectible. Like when you are sure our customer has denied, got bankrupt, whatever the case is, you are sure you are not going to collect the money. So you will book the expense. Right? Second is what? Note. It is not acceptable under GAAP because it does not match revenue and expenses. It's a very critical point. For example, I made a credit sale in November 2022, credit sales. So I have booked revenue here, obviously, of $100,000, for example, in this income statement, right? But I came to know in February 2023, I came to know this customer is not going to pay. What I will do, it means expense I will record in this year, because here I will pass entry debit, bad debts expense, and credit what? Receivable. So see, it's not matching because the revenue is recorded in one period 2022 and expenses are recorded in other period. That is why it violates the matching principle most of the time. And this is the condition for that for violation. If you have recorded the revenue in one period and you are going to record expense in the other period, it violates, right? The matching principle. This is the problem with this method. I hope it is clear. Then note this method is used only for tax purpose. So here we go. Note this. I have already discussed it. I'm going through the data now. Note a small company can use if recommended method is allowance, but write-off method can also be used in accounting if the difference between it, I would say direct write-off method, and the allowance method is what? Immaterial. Second, in other words, materiality principle is used as an excuse to violate the matching principle. Right or wrong? Because if you will ask me why you are using direct write-off method as auditor, I'm telling you, sir, it's okay because same method gives almost similar results. Right? So I'm using this excuse, but it will violate matching principle. Because I'm telling you, sir, difference is not material. Right? So that's why I'm using this. But mostly small businesses, they use direct write-off. They don't work with the allowance application. Okay? So what is the entry? Obviously here, no allowances are created. Only you have to record expense at the time of occurrence of the event. Right? So here we go to record bad debts expense at the time of write-off when you are sure this guy is not going to pay you the money. So you have to debit bad debts expense. You have to credit accounts receivable. Done? And here at the time of write-off, we are recording expense in the income statement, right? So now these three notes are important. Point number one. This method does not involve a reduction in the amount of recorded sales. The reason, sale, whatever you have recorded, it is not going to be reversed. You are going to debit expense and receivables. Sale is unaffected. This is the first problem. Right or wrong? Because customer belongs to that sale. He got bankrupt and he is not going to pay, but we are not reversing the sales, but we are recording the expense. Profit won't be affected. Then guys, due to this point actually. Now guys, the direct write-off approach violates the matching principle as I told you. And this method delays the recognition of expense because revenue are recorded in one period and expenses you are recorded in the other period. So obviously, so you are using a technique to delay the recognition of expense, which is not good. Additional entries are the same, guys. So these are the same entries because these entries will affect receivables also at the time of credit sale. We will debit receivables, credit sale. Same entry we discussed. At the time of sales return, we will debit sales return, credit receivables. At the time of collection from receivables, debit cash, credit receivables. These entries are the same as we discussed before. Only this entry is going to change because here no allowance is created. Only here you will record expense and you will credit receivables at the time of bad debts, write-off. So you have to debit bad debts expense, credit receivable. Here what happened, note, write-off a particular bad debt has effect on expense here because you are booking expenses. Understood? Now guys, here what to do? entry number 6, it is also going to be changed. Entry number 6. What is entry number 6? Note. At the time of recovery of bad debts, what entry you will pass? That recovery of bad debts previously written off. Obviously, first you have to reverse this entry ideally. Reverse it. You have to debit what? Receivables, credit what? Bad debts. And then you have to record normal cash collection. You have to debit cash, credit, receivables. So you can see here, this receivables are going to be netted out. Right? Only do you can pass direct entry, debit, cash, credit. Bad debts expense you can credit, because if you will credit expense, it will reduce expense. Or you can credit to the bad debts recovered account, another ledger. It's like income account. Because expense ledger, reduction in expense is also increase in profit. And if you are recording bad debts recovered as an income, it will also increase your profit. Net effect is the same. Understood? Note, it has no effects on the carrying value of receivables, because one time receivables you have added, deducted, and one time receivables you have added. It won't be changed, right? At the time of recovery, I'm telling you. Okay. Now we have here summary, which you have to memorize, because here in balance sheet, how you will record the receivables under direct only, you have to record net receivables. Right? You don't have any allowances. Only receivables you have to put. Understood? And only receivables ledger is important. So here we go. You have here, you will have opening balance of receivables plus credit sales, less sales return, less collection from customers, less account receivables return up. This is equal to what? Closing balance of gross receivables. Okay, if any one item is missing from here up to this, so this is, you have to reverse the equation. If you are required to calculate this value, you have to come straight away. Okay, understood? Yes, guys, please confirm through the chat option. Is that clear? Okay, guys, now we are going to talk about one more topic about receivables. That is called what? Account Receivable Factoring. Yeah, please. Accounts Receivable Factoring. What is factoring? Let's have a look with the help of example and try to understand what I'm explaining here. Definition of factoring. It's another topic in receivable. What is factoring? A factoring is a financial transaction in which a company sells its account receivables. The word sell there, but sometimes it is not a sale. Okay, account receivables to a finance company. That finance company means that specializes in buying receivables at what? Discount. And the company is buying receivables called what? A factor company. So let me give you example in order to understand, then we will go through. For example, please understand here. With the example, I'm going to explain. Guys, for example, there is a company A. Company A has a customer with the invoice amount of $50,000. This is the amount receivable from the customer. Okay. But customer has a promise to pay after maybe how many months? Let's assume 3 months. This is what is the actual performance. And this is what we have agreed with them through the credit terms. But maybe due to any reason, maybe as a company A, we need cash today or maybe within 1 week. We called the customer. We asked him, are you able to pay within 1 week? He said, no, as per promise, I will pay only after 3 months. but we need cash. So what we can do? We can take this invoice to which company? To a factor company. Maybe it could be a bank. Some people were dealing with a gold. So we have some invoice discounter, right, in our respective countries. So we can go to them. We can ask them that this is the customer. For example, customer is from royal family. Let's say. We told him that this customer will pay after 3 months, but we want money today. If you can give us the money against this invoice, right? And he agreed. The bank is going to agree with him, but there is a contract now. In contract, the factor company is going to provide us the finance. So he is having two doubts in his mind. Doubt number one, here I'm putting. He's saying in case of bad debts, I'm assuming, in case of bad debts, if customer will not pay, who will return this money? Now, as a company A, we might have two promises with them. Promise number one, as a company A, we are taking the responsibility of bad debts. What? We are taking the risk of bad debt. Risk of bad debt means to say what? If customer will not pay, company A will return the money of the factor company. Right or wrong? It means bad debt risk is with whom? With the company. Right or wrong? So here what you will do? Here what you will do, guys? It means it is not a sale of receivable. It means it is a loan against invoice. Because we are taking still responsibility to repay. Right or wrong? Understood? Okay, and this contract is called recourse factoring. What? Recourse factoring. This kind of agreement where company is taking responsibility for bad debts, it's called what? Recourse factoring. Okay, what it is called? Recourse factoring. Recourse. If it is a recourse factoring, as I told you, here we are treating this transaction as loan against invoice. It means here what you have to do, what is accounting treatment? Accounting treatment is you as a company will not de-recognize the receivables. De-recognize the receivable means to say you have to keep this receivables in your balance sheet. You cannot remove it because it is not a sale. It means there is no de-recognition of receivables, right? From balance sheet. Second one is what? You have to add loan as liability in your balance sheet. Understood? Now there's another agreement. Again, going back. Again, we need a loan as a company, sorry. We have a customer owing money 50,000 to us. He will pay after 3 months. We need money today. We went to the factor and he asked us, okay, take the money, but who will repay my money in case of default of customer? Here what we are as a company going to agree with the bank. We are going to agree that no. Case number 2. Company A is saying no, bad debts risk we are not taking. You have to take. If customer will pay, it's okay. Otherwise, you cannot ask us on this condition. If you want to give, grant us the loan. Give us the money. Otherwise, don't give. Right? It means here who taking the risk of bad debts? Factor, not company. Here who is taking? Factor is taking the risk of bad debts. Understood? It means here risk of bad debts is transferred to which company? To a factor company. It means it is like a sale of receivable. What it is called? This transaction qualifies as sale of receivable, like as you sold the receivables. Now it means if it is the sale of receivables, then what? You have as a company A, you have to recognize what? You have to recognize the receivables from the balance sheet. You don't need to book as a non-liability. Right? Or it is a sale of receivable. You have to remove the receivables from your balance sheet. And this arrangement, when bad debt risk is transferred to the factor, so this arrangement is called non-recourse factoring. What? Non-recourse factoring. Non-recourse factoring is also called without recourse. And recourse factoring is also called with recourse. Remember the words, huh? Okay? Without and non-recourse factoring same. With recourse and recourse factoring is the same. In recourse factoring, you have to record as a loan. It is not a derecognition of receivables. You don't need to derecognize. But in case of sale of receivables, you have to derecognize the receivables. Understood? So this is what is the theoretical concept. Let's go through the quick examples. Okay, so here we go. When you are transferring receivables, what? Without recourse arrangement. Without recourse meant to say non-recourse arrangement. Non-recourse meant to say what? Who is having the bad debt risk? Factor takes on all the risk of uncollectible accounts. It means it is like a sale of receivables. Right or wrong? If it is sale of receivables, as a seller, as a company, we need to derecognize, right? And notice what? Factor will charge what? High factoring fee, because there is a fee obviously for this arrangement, because he is taking the risk of bad debts. He will charge high fee also, okay, which is mostly applicable on percentage of receivable. Got it? Understood? Then guys, how it will work with the example, let's have a look, just small example, because at the end I will tell you how exam question will be tested. So they're saying ABC company transfers of how much? $500 of receivables without recourse for a proceed of $400. Actually, then why is the amount is 500? Okay, it is without recourse agreement. It means it's a sale of receivables, but you are going to get cash of what? 400 today. Let's give 100. You are not going to collect ever in future. Okay. Now, what entry you will pass? First of all, you have to debit cash because you have received 400, and you need to derecognize the receivables also. Remove the receivables from balance sheet by crediting 500 because this was an invoiced amount, right? And you have to debit obviously the difference because you received 400 by giving the invoice of 500. So the difference we will take what? Interest expense or factor fee, whatever, but it's expense. Okay, guys, this is how you will deal with it. Now, guys, this kind of examples or question could be tested in your exam. Let's have a look. Mostly, this is an example for that for the factor. Okay, a factor charges 2% fee. Fee is always applicable on sales value or receivable value. We are assuming sales value is equal to receivable value. Okay, and factor is going to charge how much fee, guys? 2% fee plus an interest rate of 18% on all cash advanced to the transferor of account receivables. Is going to charge you two type of fee: interest plus factor fee. Okay, arrangement fee. Monthly sales, I'm assuming is equal to receivables here. Monthly sales are how much? $100,000. I'm assuming it's amount of receivables. And the factor advances what? 90% of receivables. It means factor is going to give you how much? 90,000. Because receivables are how much? 100. He's going to give you loan equal to 90%.
Yes.
Okay, please focus with me here. What about remaining 10%? Here I am assuming the 10% he will pay us in the future. He's not going to deduct separately this 10% also. I'm assuming. But in your exam question, it will be mentioned about this 10% also. If nothing is mentioned about this percent, 10%, we will assume it will be recovered in future. Okay? So he's agreeing with you that we will give you 90% of receivable value as a loan, but after deducting the 2% fee and the interest in advance. So let's have a look how it is going to work now. And these credit terms are what? 60 days. It means customer will pay after 60 days. It means we need a loan only for 2 months. Right or wrong?
Yes.
Because you have a deficiency of only 2 months. Done? So here we go. Okay, guys, here we go. Question is what is the cost to the transferor? Like how much is the cost to the company who is taking loan against what? Receivables. Cost to the transferor. This is the process which you have to follow in your exam also. Same process. First of all, you will take what? Amount of receivables submitted. It is how much? $100,000. You will deduct 10% reserves, which is how much? $10,000. 10% because he is giving you 90%. 10 is keeping, right? So that 10% he will pay us in future. We are assuming. Then we will deduct 2% what? Factor fee. Because this fee will be applicable always on receivables value, which will be 2,000. Deduct. And this is the amount accruing to the transferors. How much? 88,000. And you can say this is amount which as a company we are going to receive. But still, this amount of loan, simple words. This is the amount of loan which is going to give us. But he said he is also going to deduct 18% of the interest. Right? And how you will calculate now? You will take this amount of loan, 88,000, times what? 18% rate of interest, which is given somewhere in the question. Right? And this will give you annual interest if you will multiply this. But if we need interest for only 2 months, because credit terms are for 60 days only. Right? So we will multiply what? With the 60 over 360. 60 is what? 2 months, 60 days. 360 is what? Days in a year. It could be 360 or 365, we will tell you. So you can simply take 2 over 12. Right? But in exam question, you will specify the number of days in a year. Okay? Here I'm assuming 360 days. It could be 365 also. So, then guys, this will give you amount of interest for 2 months, 2640. He will deduct in advance. And the remaining amounts to be received what? Immediately. Right? How much? 85,360. This is the amount which company will receive. Now, please remember, because he's asking what is the cost to the transferor in the question. Cost is what? This is the factor fee is the cost, plus this is the cost. So total cost is going to be how much? Add these two values. 4,640. This is the answer. But if you want to know accounting entry also, so this entry we will pass, look at here. First of all, we have debited the cash. What we received? We received 85,000. Here I'm putting here. Debit cash. 85,360. We will debit receivables from factor, from home factor, because this 10,000 he will pay us in future. Right?
Yeah.
Right, around 10,000 he will pay us future, so we have to debit 10,000. You will debit here this factor fee as expense also of 2,000. You will debit here prepaid interest, because interest you paid in advance.
Yeah.
By which value?
2640.
2640. If you will add all these values, this will be 100,000.
100,000.
And you will credit what amount of receivables by 100,000. If it is loan, you will credit loan.
Yeah.
Right or wrong? If you sold it, you will credit receivables. Understood?
Yes.
Now, guys, what to do with this prepaid interest? Obviously, this loan is for how many months?
2 months.
2 months. 2 months. If it is for 2 months, so simply you have to every month you have to pass amortization entry. Right or wrong? So what you have to entry every month, you will debit interest expense and credit what? Prepaid interest. Month and entry. Total amount is how much? 2640 divided by 2. Because 2 entries you need to pass. 1 entry in each month. 1320. 1320 in first month, at the end of first month, and 1320 at the end of second month. And what about this? Which have receivables here from the factor, due from the factor. Whenever he will pay, we will debit cash and credit this account, which is due from factor or receivable account. Okay, this matter is solved. Okay, guys, I can make it very complicated. This factoring depending upon agreement, which type of agreement. Okay, so if you want to know more, I have one video on YouTube with the topic name of accounting for receivable factoring. But being a CMA CPA student, so this is enough, because question will be as per this pattern in your exam. What we covered it. Okay. Now, last thing I want to talk about. So sometime he might ask you what are the benefits of factoring. What are benefits if you are doing factoring? You have access to the cash. You do not need to wait until the maturity date. You can receive before the maturity date. You can grow your business with your own money. Right or wrong? Because it's your money, by the way, which will be collected. It's just a timing difference. Right or wrong? So if you are doing factoring with non-recourse factoring, so bad debts risk will also be transferred to the factor company. So this transaction will be classified as then sale of receivables. Right or wrong?
Yeah.
So, but the negative points are what? Because you are selling your receivables, it shows, it might show maybe poor management of receivables. Right or wrong? You are going to others. This is the drawback. Right or wrong? Because when you are giving receivables in other hands, maybe you might lose some controls also.
Yeah.
Right? So these are negative points. So just you have to go through this topic, and then you have to go through the questions. Okay, guys? From your software, because we are studying unit number 2, right? In unit number 2, if you have access to the book, guys, so it is the topic number 2.1 we have studied. Okay, 2.1 from the book, and when you will do for the software question, you have to do for 2.1 only.
Yeah.
So I'm going to stop the recording of this video now, and then I will explain to you guys how to use the software. Just wait.